Okay, this is Chapter 1, Lecture number 2 from CFIN7, talking about the primary forms of business in the U.S. The first is a proprietorship, an unincorporated business with one owner. This is the small business, mom and pop type business in most cases. And then we go on from proprietorship to a partnership. That's very similar to proprietorship, unincorporated business with two or more owners. And then we corporation, legal entity, separate, distinct from its owners, but it conducts businesses for its owners. So corporations offer many legal protections that proprietorships and partnerships don't. The proprietorship, the advantage of the proprietorship, it's very easy to start a business. There aren't very many regulations, and there's no double taxation. Double taxation comes in the form of, with corporations, that their dividends are taxable as well as their income. So the dividends are taxed after the company's already paid its taxes. So, limitations: unlimited personal liability. This is important. In a proprietorship and a partnership, the owner or owners are liable for the actions of the business. Even things such as like a slip and fall could literally bankrupt a proprietorship or partnership. Limited life, they typically only last as long as the owners are alive. Transferring ownership is difficult, and it's difficult to raise large amounts of capital. It's in most cases it would be based on the wealth or the wherewithal of the owner of the proprietorship. Partnership, just very much like a proprietorship, except there are two or more owners. Same advantages and disadvantages and limitations of the proprietorship. They can generally raise a little more money because there are multiple owners as opposed to a single owner. Now, corporation, it's a legal entity. Its advantages are unlimited life. It goes on as long as the corporation is a viable entity. It's easy to transfer ownership. You generally just sell the stock to another owner, and that one, the business continues. Probably the most important of all, limited liability. So because it's a separate entity, it creates a barrier where the owners are not liable. So if you benefit from this if you own stock in any form, because you're not liable for the actions of the corporation. It's a very important, probably the most important issue. Ease of raising capital. The corporations can issue stocks and bonds, which is virtually impossible for a proprietorship or a partnership. Disadvantages: cost of creating, reporting, and filing. We'll talk a little bit about Sarbanes-Oxley and the burden that places on corporations. Double taxation, we talked about that with regard to the taxation of income and the taxation of dividends. The taxation of dividends gives a significant advantage to debt, because the interest payments on debt, on bonds and so forth, are tax deductible, while interest payments on dividends are not dividend payments. We also have two hybrid forms of business: limited liability partnership. It's just limited liability partnerships are very common in accounting and law firms. They offer some protection with regard to liability, but it's not anywhere near the level of what we have in a corporation. We have another hybrid form of business called LLC, limited liability company. A limited liability company is somewhere between a proprietorship and partnership and a corporation. It offers the protections of incorporation, yet the restrictions and responsibilities of that LLC are not anywhere near as great as they are with a corporation. Another form of business is an S corporation. An S corporation is limited to no more than 100 stockholders. So the important thing to know about all of these is you're able to escape the double taxation of dividends with all of these, because the income flows through to the partners or the shareholders, and the LLC or the S corporation. So we'll start with lecture 3 with value maximization of the corporation.